Hey everybody. As you all know, we're discussing the impacts of COVID-19 on our economy. Um, in 3 short months, COVID-19 has brought our economy and the global economy to a screeching halt. The volatility index has never been this high, except for maybe in 2008. You can look on the chart behind the slide and see that um, consumers' confidence in the economy is very, very unstable right now. And our economy, because of this, is facing challenges like it's never seen before. The closest comparison is 2008 and the Great Depression, but this is just a completely different set of challenges in front of us. Our current workplace strategy has completely changed because of this. We're looking at Zoom meetings and emails instead of sitting in a conference room and being face to face with people, which has been a difficult transition, but I think we've adapted pretty well so far. Our economy is facing current challenges that we've never seen before. Um, these challenges have led to an extreme economic contraction in an extremely short period of time. And it's an immediate economic impact. So that's why it's radically different than 2008. 2008 was a trickle down effect of greed from Wall Street and buying and selling bad assets, whereas this is a global pandemic that affects everyone. Low income, high income, it doesn't matter who you are. You can't stay untouched from this. Biggest impact we've seen is on hospitality workers, and in real estate, student housing, elderly housing as well, senior housing, um, and then even just um, in the housing market as a whole and selling new homes. It's been extremely difficult because agents can't do showings, um, and in the commercial sector as well. You can't show people new office space. It's been extremely difficult and has quickly impacted every part of our economy. We've had an extreme rise in unemployment in a very short period of time, and market volatility, as we mentioned before, is at an all-time high, which is immediately going to make people more nervous to put their cash in any kind of asset besides bonds and precious metals. Uh, the volatility is going to have people fleeing from the equities market and even fleeing from the real estate market. The biggest challenge that we're looking at, though, isn't the economic one. It's the health concerns for all Americans. Our entire nation has confirmed cases. There's not a state that hasn't seen one yet, and the entire world has seen it pretty much. Um, so, with the entire nation having confirmed cases, that is the biggest challenge we're facing: is how to handle that. Um, and especially for our workforce over 50 years old. They're one of the most significant portions of our workforce. They have been a pillar of the economy that we have now, and currently they're at the most risk for dying due to COVID-19, and that's a huge risk that we have to look at, and a huge challenge that we have to figure out how to overcome. So, despite these challenges our economy is facing, there are some highlights to be found. One, offices have adapted extremely quickly and efficiently to remote workplaces, working from home. Great example of that is this presentation right here. We had to realize quickly that our presentation wasn't going to happen and it had to be moved into PowerPoint. And so this is a great example of that. Also, private businesses have been switching from manufacturing what they normally do to manufacturing personal protection equipment and hand sanitizer. A great example of this is Apple. They've pledged a large amount of personal protection equipment due to the shortage that the healthcare system is having. So, and then another great example is Chattanooga whiskey. They're an extremely small distillery outside of Chattanooga, and they've made fifths of hand sanitizer and pledged that all the proceeds to this go to helping displaced hospitality workers due to the pandemic right now. So those are two really cool examples. And then another highlight is the $2 trillion stimulus package called the CARES Act that was passed by the Trump administration. Um, this stimulus package has $367 billion in small business lending, um, and it has a significant increase in unemployment benefits, um, and then also has $150 billion allocated to state and local governments to help fight COVID-19. and that might be the most significant. And that $150 billion is getting allocated to local economies where local governments can decide where it's needed the most for them because it looks different. Um, for example, here in Clemson than it does in Orlando, Florida. And so I think the stimulus package was designed with that in mind and realizing that this can't just be one big band-aid. We have to be able to pass out what's needed to every single local government so that they can handle this outbreak effectively.
Inverted yield curves preceded both recessionary environments, but to caveat that, prior to the Great Recession, the Federal Reserve held the Fed funds rate, or interest rates, around 5.2% prior to the yield curve inverting. In contrast, the beginning of year Fed funds rate in 2019, prior to the yield curve inversion, was sitting at 2.4%, leaving less insurance, so to say, for the Fed to manipulate markets. In conjunction, a pickup in quantitative easing activities also mirrored Great Recession responses. Corporate execs are holding a pessimistic outlook for defensive purposes, especially among those who sat at the helm of Fortune 500 companies while weathering the 07-08 financial crisis. Jamie Dimon, CEO of JP Morgan, recently highlighted in a quarterly earnings call, "At a minimum, we assume that it will include a bad recession combined with some kind of financial stress similar to the global financial crisis of 2008. Mr. Dimon is known for championing a fortress balance sheet approach, and this could be influenced by prior biases. Negative economic impacts transcend individual sectors, and the downturn is pervasive throughout the entire economy, hitting some major sectors more so than others, but the major difference is the lack of a domino effect seen during the Great Recession. COVID-19 has been abrupt and all-encompassing in its own right. Government intervention in the form of corporate and individual stimulus has been apparent through the crises. This time, however, there seems to be a greater focus on individuals with cash infusions and child cash credits being dispersed to the American people, while the $700 billion bank bailout rolled headlines in 2008. Systematic failures are not the cause of financial duress in 2020. In review, our major financial institutions were leveraged 1 to 40 while using our FDIC-insured accounts as collateral and relying on credit rating agencies that had been corrupted by competitively generating fees to accurately rate collateralized subprime loans. Although real estate, both residential and commercial, have taken a hit from COVID-19, they are simply collateral damage and not the precursor for a widespread effect. Legislation has been passed to correct these systematic failures and reduce moral hazard and enforcing stricter corporate governance. Tier 1 capital buffers for banks was increased, as well as more stringent risk parameters for operations and investments. Saving and loan institutions must now critically vet borrowers before making loans. Compensation relating to performance has to an extent been improved, ensuring irresponsible risk-taking is curbed. Jobless claims are expected to rebound subsequent to the reopening of the economy and the relaxation of social distancing practices. Unlike the Great Recession, which saw many companies fold, resulting in layoffs, many workers are currently furloughed. Workers that have been laid off in the service sector will likely be able to find work once brick-and-mortar retail and eatery establishments are allowed to operate again. A more granular look at employment is touched on later in the presentation. Recovery from COVID-19 is expected to be steadfast, depending on a few variables, such as how long stay-at-home orders are in place and how consumer confidence rebounds. Both of those factors could be uplifted through the discovery of a vaccine. However, clinical trials and approvals take as long as 18 months. Many analysts are expecting a healthy recovery within the next 2 fiscal quarters. The Brookings Institute expects a V-shaped recovery, unlike the elongated U-shape resulting from the Great Recession. Thank you.
Hi, this is John Roof. Let's begin by talking about the COVID-19 effect on the economy. The American economy is in a contraction. The unemployment rate has skyrocketed over the past 2 months, reaching a 14-month high at 4%. As employees lose their income, the buying power is becoming more and more limited. This has caused liquidity problems for both American businesses and individuals. COVID-19 has reduced demand in the global economy, which has caused a complicating factor in the supply chain of many businesses. In a global effort, members of the G20, which is an international forum of governments and central bank governors, which is seen below, say they'll do whatever it takes to overcome the pandemic. This group is pledged to funnel over $5 trillion into the global economy to slow down unemployment and to cut individual income losses. Here in the United States, the government has implemented a $2 trillion stimulus policy. $500 billion is intended to help the industries that have been affected the most by the coronavirus. The government is also preparing to fund families up to $3,000 to help with purchasing power due to unemployment reducing individual income. The Federal Reserve itself has taken many actions to provide relief during the COVID-19 pandemic. They begin by lowering the federal funds rate by 150 basis points to 0 to 0.25 basis points. They also lowered the cost of the discount window. As many other countries have done, the Federal Reserve has bought back many asset packages, including treasuries and agency securities. Household government agencies such as Freddie Mac and Fannie Mae have stated that they will suspend all foreclosures and evictions by 60 days. In relief with individuals struggling with the constant flow of income, they have also decided that they will reduce or suspend mortgage payments for as long as up to a year for those who have been directly affected by the global pandemic.
My name is Ryan O'Keefe, and I'm here to talk about the United States consumers' purchasing power. So since the World Health Organization has declared the coronavirus as a worldwide pandemic, governments around the world have ordered non-essential businesses to close and for everyday citizens to practice social distancing. These orders have presented long-term damage to small business owners and employees because small business owners are losing the daily income that they need to keep their business afloat. And this is forcing layoffs because businesses can't afford to pay their employees, leading to a snowball effect of loss of income for the average American citizen. This is similar to the 2008 financial crisis because in 2008, after 2008, a man named Michael Snyder described the effects of the 2008 financial crisis by stating that the average household was worth about 36% less than it was a decade before. And we have forecasted that the future decline in the value of real estate after the coronavirus could be approximately 35%. So this could lead to a huge spike in unemployment as we've recently seen, and this could really hurt consumers' purchasing power. And as you can see in the graph below, between the periods of 2008 and 2009, there was a huge spike in unemployment, which led to everyday Americans losing their income. Unemployment and panic. In March 2020, we saw a jump in unemployment of about 0.9% or 1.4 million people. When people lose their jobs, they panic and tend to hold their assets or sell them in order to preserve their worth, leading to fire sales, which rapidly decrease values of all assets, including real estate. A jump in unemployment also leads to more economic instability, meaning more layoffs and further tightening the economy even more. Similar to the 2008 financial crisis, the Federal Reserve has kept interest rates very low in order to spark lending and increase opportunities for borrowing so that the economy is still moving and doesn't just come to a complete standstill. With the rise in unemployment, people don't really know what is certain for the future, so they decide to hold their assets or either sell them. But with real estate, it's really recommended to hold your assets because there's short-term instability right now, but in the long term, the market will correct and we'll eventually see it flourish again like it did before, and people will eventually get their jobs back and have their purchasing power back to normal.
I'm going to discuss the impact that coronavirus is having on the housing market. I'm going to start with the negative impacts. I think the most apparent and direct impacts right now are loss of income and unemployment. Um, Most people in the world right now aren't working unless they're considered essential, so there are a lot of the population who doesn't know when they'll get the next paycheck. So I'm sure the last thing on their mind right now is purchasing a new home or purchasing any property for that matter. Not to mention a lot of lenders require some type of employment verification and payment history before they'll consider financing. The next thing is social distancing and shelter in place. The shelter in place order has been pretty much implemented nationwide at this point. So it makes it tough for buyers and sellers because typically the sellers have an open house where the buyer can come in and take a look, or the buyers will go and walk through a home and see if they like it. At this point, I believe that most parties want to be cautious and just avoid any kind of contact at all. So that makes it a lot harder to complete the transaction. And the last thing is just fear. A lot of unanswered questions. How long will this last? Will it get worse before it gets better? Things like that. So I think people want to be conservative with their money until they know some definite answers. Next thing I'm going to discuss is a potential upside. Mortgage rates are at an all-time low. I think that's a big deal. In an attempt to stabilize the economy, the government is actually purchasing mortgage bonds and mortgage-backed securities and lowering interest rates. Perhaps this could lure some potential buyers out to purchase a home before the rates start rising again. The next thing is the opportunities for current homeowners. This is a great opportunity for them as well to go and refinance. With the rate so low, there's a much better chance that the savings are going to outweigh the cost of refinance, so it'll be worth it. And the final thing is transitioning into a digital and virtual world for businesses. Virtual tours, curbside appraisals, drive-through closings, they're all different things that are being introduced right now to conduct business during this pandemic. So while they're not a necessity in the future, they definitely would give the companies an edge over competition and be useful. Next, I'm going to discuss some recommendations and potential solutions. First and foremost, I think businesses should aggressively advertise these low rates, especially lenders and mortgage companies. With all the chaos going on in the world right now, I don't think people really paying attention to the housing market, and this is something they can take advantage of. Next, I think the businesses should showcase their ability to complete no-contact transactions. I talked about the virtual tools earlier, but this doesn't only apply to realtors. I've heard some banks have started doing drive-by appraisals. I think it'll be wise to embrace this change because it's probably inevitable in the future. And finally, I think the people who are already homeowners that are considering refinancing, to keep in mind that refinancing doesn't just mean changing your interest rate. You should also consider maybe changing the terms of your contract, like the length, the years, from 30 years to 15 years, or perhaps change from adjustable rate mortgage to a fixed rate mortgage in order to lock in that interest rate.
In conclusion to our presentation about coronavirus, we have seen that the world economy has tightened a lot. The world economy has come to a standstill, according to many, and government policies have ordered certain businesses to close and for people to stay inside. Asset values have dropped significantly for the first time since 2008, and rapidly. We are seeing a really volatile market due to the coronavirus and the widespread panic that has been displayed over the past few months while we are looking to find a cure. This panic has led to a large spike in unemployment, and it harms everyday citizens' incomes and lives, caused by large decreases in demand for almost everything. There are potential negative effects on the housing market, and we have also forecasted drops of 35% in real estate values at maximum, and it's similar to the 2008 financial crisis. So with the help of government policies and their $2 trillion stimulus package that they've implemented so far, we would like to see the economy come back together and for people to get their jobs back and for businesses to afford to be able to pay rent and just basically for the economy to recover. It might take a while, but with the help of government policies like the $3,000 to support families and a bunch of it going to small businesses, we will eventually see the economy recover. So that is the conclusion for our presentation about the coronavirus and its effects on real estate executives. And next is our works cited page. Thank you.